Hi, this is Alvin from Dr. Wealth, and there's a perennial urge of traders or investors always want to time the market, and especially during the market crash. It is too painful to hold on to any investments, and there is always the tendency that one wants to sell. So, is it a wise idea to time the market? Of course, finance professionals will tell you otherwise, and today this video is to go through the pros and cons and you see whether timing the market makes sense for you. So first of all, this is the reason why the finance professional will urge you not to time the market. They always say that time in the market is more important, right? They always quote the example of if, let's say, within the decade of investment and you happen to miss just the best 10 days in 10 years of trading history, right? You will be able to you will actually underperform the market significantly as opposed to just investing it through the entire decade. So missing 10 days, for example, in 1930, right, your returns will be even worse. You'll be a minus 79% versus a minus 42%. And let's look at the latest decade in 2020. If you just buy and hold for that 10 years, right, from 2010 to 2020, you'll get about 18%. But if you miss time and you got out, miss the best 10 days in the whole 10 years, you will actually go down by 33%. So they tabulated through all the decades, and if you just hold through since 1930 to now, you get a 17,000% gain versus if you just get 28% gain, missing all the 10 days, best 10 days in every decade. So you can see there is a significant difference, and that's why finance professionals will urge you to not time the market. The chances of mistiming the market is high, and it's better off that you just do nothing about it and sit through all the crashes. Okay, so that's the first argument. And the other part of it is that the often omitted evidence is if you miss the worst 10 days of the trading days within a decade, your returns actually becomes more excellent. Okay, you can see no matter which 10 years you compare, right, it's always better missing the worst 10 days. And you can end up with a 3 million% gain since 1930. That totally blow out the buy and hold periods. So that is the counter argument why timing the market makes sense, especially if you can miss the worst 10 days of the decade. Okay, so what I did was I went to look through the sequence of returns. So I wanted to see where do the best and the worst days happen. And what I have found is that the best and worst days usually happen together. And the funny thing is that usually after, when the market has run up a lot, the tendency of the market coming back down is higher, right? And the same thing happens vice versa. That means if the market has been crashing for many days, very often that the rebound will be very strong, and that's where the best days happens together with the worst days. So you can see that this is in the period of 2011. You can see the clustering of these returns, right? So the red color is where the redder the cell is, because I did a conditional formatting. So the redder the cell means the bigger the drawdown for the entire period that we're looking at, and then the more solid green that you see here is the bigger gains. Okay, so you can see the solid red followed by solid green, solid red, solid green. So that is what I mean by there's a clustering. Usually the best and the worst days happen sequentially, right? Of course, we don't know, right, whether you will continue to be like in this case, it went red, neutral, and red again, right? It didn't rebound, but then after that, the fourth day it rebounds strongly. So it is still some randomness that's happening from day to day. Within this clustering of the best and worst days, right? It's not easy to tell, right? Not even easy for a day trader to catch this range. But of course, if you are a superb day trader that can short at the right time, buy at the right time, you will definitely make a lot of money timing the market rather than just holding through the entire period. And this is another period, 2015. You can see again clustering, right? Some continuous downtrend for a few days before it rebound back, and it's pretty solid green as well, right? Big gains within that decade. And this is 2020 during COVID, right? This is where you see a double digit drawdown within a day, right? Minus 10%, minus 11%, but in between there was a 9% up day. So and then there's another 9% update here, right? So again, a lot of clustering happens, right? So the thing is that if you try to time the market, the chances are, if when you want to miss the worst days, you end up missing the best days as well. Okay, so that is the message through this study, right? So they come together. You cannot just miss the worst day without missing the best days, okay, and vice versa. So that is one discovery, right? And let's look at the numbers. If we say that it's a clustering effect, and if we do a market timing, likely we'll miss the best and the worst days together. Okay, so what would the overall performance be? And if we compare, right, versus a buy and hold, there is still outperformance if you miss both the worst and the best 10 days per decade. And why is that so? Because the impact of missing the worst 10 days is higher, much higher than missing the benefits of missing the disadvantages of missing the best 10 days, right? So the missing the worst days, the impact is a lot more significant, right? So that is why if you miss both, you will still end up better than a buy and hold situation. Okay, so which means timing actually works, right? If you miss the worst days, okay, and it's even if you miss the best days, it's still worthwhile to do so, right? As the numbers suggested. So how then do we time the market? One way is to use a simple moving average, right? For example, this is on S&P 500. Anyway, the data that we have been looking at is all S&P 500 ETF. Okay, so in this case, this is a chart of S&P 500 ETF, and this line is called the moving average line. It's a 200-day moving average. Of course, the numbers that you want to use doesn't matter, right? It depends. You want to use 100, 150, or some special number that you concocted. But basically, I think anything between 100 and 200 will make sense, right? Anything more, it becomes a bit too late to sell, right? So how this works is that if the price goes below the 200-day moving average, you sell. And if the price goes back up, you buy, right? So that is what timing is. And we talked about the clustering, so likely your best and the worst days are going to happen here. Okay, your best and worst days. So you'll miss both, right? You'll miss both sets of best and worst days. And then you just hold on until it goes down again, right? So there's some false signal, there's some whipsaw over here. So you will buy, sell, right? But it's still worthwhile because eventually when it goes down, that's where you get your protection of your capital. Likewise, your best and worst days are likely to be here, right? So you miss them both. And let's see how would this perform. Let's look at the performance, right? Compare this moving average strategy versus buy and hold. Which one will turn out better? So I did a back test, and this is what I got. So the moving average model, right, is represented by this blue line. And then the buy and hold model is represented by this red line. This is the performance curve. And if we take a look, of course, the blue line has been above the red line for long periods of time, right? But the performance differences is not a lot. So we look from 1995 to 2022. If you compare the per year return, the average moving average strategy will give you the 10.89% return, while the buy and hold will give you a 10.33%. So there is a 0.5% outperforms each year. And of course, if you take a length of about 20 over years, 10,000 balance initial investment can turn into 170K for moving average model, whereas a buy and hold will end up with about 150. So there is a 20,000 difference after 20 years. So that is not a big difference. I would just say there's a slight difference. Of course, if the number of years increase, then the differences will expand, right? Because we're talking about 0.5% outperformance per year. It's just a simple moving average. But I think the biggest benefit from this moving average model is that you look at the maximum drawdown, right? If you compare to this, then the timing model is definitely more superior. Because if you just buy and hold, at one point in time, you can suffer half of your portfolio value is gone, right? Because the market crash can bring down 50% of the portfolio value, halved it. And for some investors, it is just too difficult to swallow, right? Seeing your money evaporate out of thin air. And if you use the timing model, it will help you avoid the very bad days, the worst days, and your drawdown is just maximum minus 17%. And I think this is something that is more palatable, right, for most investors. Even you can see from the equity curve, right? See, when the market crashes, the moving average model, portfolio didn't really move because it goes to cash, right? So you can see even in COVID, in 2008 financial crisis, and then the dot-com crisis. So it has been proven, this moving average model has been resilient. It has worked in many of these crashes in the past, right? And these are not small crashes. These are very major crashes that can go down 50% or even more in any time period. Right, so that is why I think that the biggest benefit of this timing is actually reducing the drawdown. Not so much of the excess gain, right, but is to at least make the investors feel more confident, right, more comfortable during a crash. So in conclusion, timing the market actually works, right? It actually does better than time in the market, okay, although the difference is not a lot. And the point is about missing the worst days more than trying to avoid the best days, right? Of course, there can be chance of mistiming, but based on my study, I show you that the problem is that there's a clustering of all these best and worst days, and you can't just miss the worst days without missing the best days. So end up, when you try to miss the worst days, you have to miss the best days together. It is still worthwhile because missing the worst days will give you a much more significant impact as compared to the best days. So timing does provide you some outperformance still, right? But as I share with you, the biggest benefit out of it is actually reducing the drawdown. And you don't need a very elaborate method, right? Just a very simple timing tool, like a simple moving average, a 200-day moving average that I showed you just now, right, would be able to increase the return slightly, right, by about 0.5% per year. Okay, of course, the actual performance may change as we go forward, but then most significantly, I think the drawdown will reduce from 50% to 17%. That is a very, very big improvement, right? So that is what I want to share with you, right? But of course, at the end of the day, if you still choose to buy and hold because you feel that there is not much difference, you don't mind the drawdown, and you know, just doing less work is more important to you, right? And so be it. But I think at the end of the day, you want to make a more informed decision, and how all these numbers and all these actions can lead to what kind of consequences, right? So with that, I leave you with some food for thought, and hopefully you like this video. Give me a thumbs up, and remember to subscribe to this channel. I'll see you around. Goodbye.